Hi, my name's Nick Clay. I'm an investment manager at Newton on the global higher income funds. And 5 years ago this week, Lehman's went bust. And you'd be forgiven for thinking that the world was right again and that we've got over all the problems and that the central bankers around the world have solved all our issues and we are returning back to the way we used to know and love. I'm here today to try and anticipate to you that we're in a very distorted world. This is not a world where there's no risk, and this is a world which has big influences on how you're meant to invest your clients' money. Why is the world so distorted? Well, the central bankers around the world are choosing their drug of choice, which is printing of money, and they are all increasing their central bank's reserves by printing as much money as possible. Whether it be Carney in the Bank of England, whether it be Bernanke at the Fed, now the Japanese joining the party, and probably only Draghi sat there twiddling his thumbs with just promises of money to come and waiting for Merkel to let him off the leash. The point being is that this printing of money is really only addressing the symptoms of our cause. It's not addressing the cause of our problem. The cause of our problem is there's too much debt. We have built up far too much debt over the last double decade, and therefore we've done very little about getting rid of it. There's a reason for this. Getting rid of debt is very painful. It poses a lot of problems for pretty much everybody. And as a politician, you're unlikely to get re-elected by your democracy if you go down the route of getting rid of the debt. So therefore, you instead choose to do something about the cost of the debt, the interest rate, keep it low. This has big implications because it's distorting the market, but it's deliberate. Bernanke himself has admitted he wants to rewrite history. History is that the horse pulls the cart, the horse being the economy. It grows, people earn wages, they get more confident, they invest in the cart, the assets, and then the cart moves with the horse. Equity markets go up, wine goes up, etc. Bernanke believes you can change that relationship. If we push the cart, we use quantitative easing, we push up all these asset classes, bonds, equities, property prices, the confidence that will generate will move the horse, and the horse will follow, the economy will follow. And so far to date, since 2008, the world has injected $15 trillion into the world markets, and so far the cart's moved a long way, but the horse is still munching the grass. The economic growth on a global basis is 2.5%. It's barely moving. And as you can see, economic growth out in the UK, the US, Europe is still very substandard, despite all of this drugs that we've been pushing into the economies. What does it mean, though? It means that we've got a very volatile world. We've got a world in which there is lots of risk around now. Not the world we were used to where there was no risk. Now there is risk that you lose money. You held Spanish banks, you lost money. You held Greek debt, you lost money. You held a Cypriot bank account, you lost money. Therefore, there's a lot of risk around at the moment, and that has a big implication of how you should invest. Because you can either try and trade this volatility, some people do. Problem is that the time, we're here for a long time, and therefore getting that consistently right again and again is a big challenge. Or you can try something which is slightly less volatile, is a bit more predictable, is a bit more sustainable. That, though, has implications too, because you won't participate when the drugs are being pumped onto the street and the markets are going to the moon. But equally, you hopefully won't participate when everything is falling apart, and you try a smoother path through that period. What delivers that kind of dynamic? What delivers that kind of outcome? Well, equity income is certainly one of those asset classes which can deliver that kind of return. It is dividends are stable. Let's think about it. The worst a dividend can be is zero. It doesn't go down, and therefore it's more predictable, it's more sustainable, and it's that sustainability over time, the compounding of that, which ends up being a very great driver of your total return over time. But you have to be active in this area. The one thing you have to remember about high-yielding dividend income stocks in equity markets is that they're pretty poor. That's why they have a high yield. Chances are they're not going to pay you that dividend. So you have to be active. This is not something you can do in a passive fashion. You will then be sucked into, for example, in 2007, all the banks in the Western world all yielding plenty in order to get into a high yielding index, and then all yielding nothing by the end of 2008, and share prices down 80 odd %. You've got to be able to avoid that and be active. If you can get that right though, and you get a stable dividend, you get growth in that dividend, you've picked the right companies, you've picked the right cash flow dynamics, you've picked cash flows which can also respond to inflation, that will be a far, far powerful driver of your total return over the long time than trying to time the volatility in capital returns. You do that, then you can try and invest with some perspective, you'll be able to take on board the fact we're in a distorted world, and you will still be able to generate a return for your clients despite all the risks that are around, despite the fact that the world in which we're living in is going to remain distorted for a very long time.